Financial year 25-26 has ended, and as soon as the financial year ends, one responsibility automatically comes on all of us to file the ITR. But this is exactly where confusion starts. Is it mandatory for me to file an ITR? What will happen if I don't file it? What is the due date? What documents are required? And if any mistake happens, how can it be corrected? So, hello everyone. Today, I will explain this entire process step by step in a practical way so that you don't have any doubts left and you can easily file your ITR. So, first of all, let's understand who is required to file an ITR. If you are a company, firm, LLP, AOP, BOI or a trust, then you are required to file an ITR every year, whether you have any income or not. But if you are an individual, then for financial year 25-26, generally you are required to file an ITR only if your total income exceeds rupees 4 lakh. But here is a twist. In some cases, even with zero income, filing an ITR becomes mandatory. For an example, if you have paid electricity bills exceeding rupees 1 lakh in a year or spent more than rupees 2 lakh on foreign travel, or if your total deposits in current account exceeds rupees 1 crore or total deposits in your savings account exceeds rupees 50 lakh. If you are providing services and your gross receipts exceeds rupees 10 lakh and your business turnover exceeds rupees 60 lakh. If you want to carry forward your losses, or if you are a director in a company or a partner in a firm, or if your total TDS or TCS exceeds rupees 25,000, 50,000 in case of a senior citizen. In all these situations, filing an ITR becomes mandatory even if you have no income. Now let's assume you are required to file an ITR. Then the next step is to keep your documents ready. If your documents are sorted, ITR filing becomes half easy. First of all, PAN and Aadhaar, then details of your bank accounts. If you have salary income, then Form 16, all bank statements, home loan statement if applicable. If you have sold shares, mutual funds, property, then details like purchase date, sale date, purchase price, selling price should be ready. If you have rental income, dividend income, freelancing income, then it should also be noted. And one thing that many people ignore, Form 26AS and AIS. These forms contains all the data available with the department, that is TDS, TCS and high value transactions. So make sure your ITR matches with these records. Now when you sit down to file your ITR, you will see 7 ITR forms. So the question is, which ITR form should you choose? Understand it simply. If you are salaried person, ITR 1 or ITR 2 form is applicable. If you have business or professional income, then ITR 3 or ITR 4 form is applicable. In case of a firm, AOP, BOI, ITR 5 form is applicable. In case of a company, ITR 6 form is applicable, and in case of a trust, ITR 7 form is applicable. One golden rule to remember, the form is selected based on the nature of income, not convenience. Now the next step is reporting your income. And here is the most important concept is reporting income under the correct head. If your income is from salary or pension, it goes under income from salary head. If it is rental income, then income from house property head. If it is business or professional profit, then profit and gains of business or professional head. If you sell property or shares, then income under the head capital gains. And if any other income like savings interest, FD interest, then income from other sources head. If there is a mistake here, your return may become defective and you may receive a notice. When all incomes are added, your total income is calculated. But while calculating this, you must also check which deductions and exemptions are available. For example, rupees 75,000 is standard deduction in salary or pension, 30% standard deduction on rental income, 1,25,000 rupees exemption on long-term capital gains on sale of listed shares or equity-oriented mutual funds. If these are properly claimed, your income will reduce significantly and your tax liability can also reduce. Now comes a practical part. How is the final tax calculated? The tax you calculate is not final. From that, you reduce advance tax. If your estimated tax exceeds rupees 10,000, you are required to pay it in 4 installments: 15th June, 15th September, 15th December and 15th March. This advance tax is paid in the same financial year on an estimated basis. So while filing ITR, it is reduced from your total tax liability. If you do not comply with advance tax, then heavy interest is charged. Then comes TDS, which is already deducted from your total income, like FD interest or salary income. So if the TDS is already deducted, it is also reduced while filing the ITR. And TCS is the tax you have paid on certain transactions. For an example, 1% TCS on purchase of a car exceeding rupees 10 lakh. This is also reduced. All these amounts, advance tax, TDS, TCS, are available in Form 26AS and AIS. Now let's understand the ITR due dates for financial year 25-26. If you have salary or pension income, then 31st July 2026. If you have business or professional income, then 31st August 2026. This is the new due date introduced this year. Earlier it was 31st July. If your accounts are subject to audit, then 31st October 2026. If you miss the due date, you can file a belated return till 31st December 2026. But then late fees and interest will apply and losses cannot be carried forward. If there is any error, omission or wrong information in your ITR, you can file a revised return till 31st March 2027. If you revise between 31st December and 31st March, late fees will be applicable. This is also a new change. If you have not filed ITR at all, neither original nor belated, then you can file an updated return till 31st March 2031. But it has limitations and additional taxes has to be paid. One step that people often ignore: ITR verification. After filing the return, it is mandatory to e-verify it within 30 days. If not verified, the return will become invalid and it is considered as not filed at all. Now quickly, let's look at some common mistakes: choosing the wrong ITR form, selecting the wrong head of income, mismatch with AIS, not reporting high value transactions, ignoring advance tax, not claiming TDS or TCS, not filing ITR in case of losses. And finally, benefits of filing ITR. Banks ask for last 3 years ITR while approving loans. ITR is required for visa processing. It helps in claiming TDS refunds. ITR acts as an income proof in cases like share market transaction, property purchase or high cash deposit. Filing ITR helps avoid notices. It helps in carry forward losses and it is important for government tenders and contracts. So overall, ITR filing is not complicated. You just need correct information, proper reporting and timely action. So I hope you found this video useful and informative. See you in the next video with more such informative content. Thank you so much for watching the video.